You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everyone, I hope you had a wonderful holiday weekend 2 weekends ago. I know I got a lot of time with my family, extended family, spent a lot of time outside, and just enjoyed a little bit of downtime, a little bit of a longer weekend than normal. So I hope you did too. The market continues to struggle. It's choppy, it's volatile. The market's down. And when I say the market, not just the stock market, the bond market is down. In fact, I think it's down the worst it's ever been. In fact, if the market continues, or if it were to end today, we'll say, if the bond market were to end today, it would be the worst bond market that we've ever experienced in U.S. history. So things have been rough. You know, it's been a rough first half of the year. And I talk about this elaborately in our annual halftime update, which went out last week on our Libertas YouTube channel. So if you want to check out the full 47 minutes of nerdiness and long-winded chart talk, it's a lot of really, really great information, really, really valuable, but it is nerdy, so beware. But if you want to check that out, head over to our Libertas YouTube channel. Be sure to subscribe and check out our half-year market update, and there'll be a whole lot more there. But I do reference a few of the charts in today's podcast because what we're talking about today is emotions and how emotions make humans terrible investors. Not to say that we need to be complete robots here. I mean, we have to make decisions, and sometimes when we make decisions, we make mistakes. You know, sometimes when you look at the news, you listen to the radio, you're getting emailed 6 times a day from things that are scaring you in the market, scaring you having to do with recessions, politics. It doesn't really matter, but there's so much noise out there that's potentially causing you to make a mistake. And what I mean by that is make mistakes when it comes to your money, whether that's making a change in allocation, whether that's selling and just taking your money out of a strategy that you built in advance. And that's the thing about being robotic, is that when you build a strategy and it makes sense and it's tested over the long term, then you should be able to stick to those rules. If you don't follow the rules, of course, every decision you make is a mistake. But if you have rules in place, if you have a strategy that makes sense for you, or a combination of strategies, which we'll talk about in a little bit here, then this shouldn't be something that you need to pull the ripcord on and jump out of the airplane, or jump off the building, for that matter, I guess is the more heavily used cliche. So let's jump into this information today, starting with our quote of the day, as always. This is from Don Connolly. Don Connolly was actually someone I would call my first mentor, or at least my first real mentor. He's a consultant to financial advisory firms. He's also a speaker, an author. But he said, this is way back at the beginning of my career. He said this to me, and I just thought it was hilarious. He said, the stock market is the only market where things go on sale and all the customers run out of the store. Think about that for a minute. And every time the market goes down, well, let me back up. Whenever the market goes up, people have a tendency to want to wait to invest because they don't want to invest when prices are at all-time highs. It kind of makes sense, I guess. People are hardwired to want a sale, right? But when the market goes down, what they typically say isn't, oh, great, here's the sale, now it's time to invest. What they say is, well, I'm going to wait for things to get better first. Well, in order for things to get better, prices have to go up, don't they? So it's kind of, a fun quote. Don Connolly, he said, the stock market is the only market where things go on sale and the customers run out of the store, and it's so, so true. Here's proof of that. Or I guess we'll just talk about the sales. I did a study. I was just curious, and I didn't know how it would turn out, but it was interesting. And if you're watching on YouTube, you'll see a chart here in front of you. If you're listening on iTunes or one of the other social media or podcast mediums, I'll talk you through it here. But what I did was I pulled up a chart of the S&P 500, so the stock market going all the way back to 1950. That's 72 years. And what I was curious of is how many times the market had gone down 20% or more since 1950. And that would be most of the people who are listening right now. You were at least working, the oldest folks listening right now or watching right now, you were maybe starting your career in 1950, perhaps. So you were starting to save money. So maybe this is legitimate from the standpoint of where you could have actually had skin in the game, we'll say. But for most of you listening, you didn't even have an opportunity to take advantage of the sales back in 1955, 60, 65, and so on. But what we're looking at here is every time the stock market has gone down 20% or more. And what I found, I'm going to count it right here. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. There have been only 13 times since 1950, so 13 times in 72 years, that the market has gone down by 20% or more. Now, one of a portfolio manager I very much respect that I saw speak back in the late 2000s, he once said that, if you're trying to pick the bottom, give up, because the only kinds of animals that pick their bottoms are monkeys. So we're not going to pick the bottom. It's impossible to invest at the bottom. So we have to start asking ourselves questions this time, not last time. You had 13 opportunities in the past to buy and invest your money when things were on sale, or at least reallocate your money when things were on sale. The question then becomes, okay, so we're looking at this market that we're living in right now in 2022. Is the market going to go down further? If you asked me, I'm the professional, right? I'm the expert. I'm the chartered market technician over here staring at stock charts all day. If you ask me, my answer would be, I don't know. And anybody who tells you that they know, you should just put your gym shoes on and run as fast as possible, because no one knows. No one knows how to predict the future of the stock market. If that were the case, it would be a straight line up. Or, in fact, when it comes to psychology, not to get too nerdy here, if someone figured that out, then all of a sudden there'd be this very, very quick recognition of that trend, and the market would adapt to it. But I digress. My point is to say that we don't know where the bottom is until it's in the rearview mirror. And as a result, what we need to do is we need to think logically. We need to not think with our emotions. We need to think logically, and we need to use history as a reference. When I look at this page, we can see that there's been 13 times since 1950 that the stock market has gone down more than 20%. If I go through every one of them individually, the first one was down 21.5%, the second 28%, the third one 22.2%, the fourth 36.1%, the next one was down 48.2%. That was the early 70s oil embargo. Then we have a drop of 27.1% in the early 80s. Then we have a 33.5% drop during Black Monday. And then we have the 47% drop that occurred during the dot-com bubble and the World Trade Center attack, a 57.8% drop during the mortgage crisis, a 33% drop during COVID, and now what we're in the middle of is, depending on whether you're looking at the S&P or the NASDAQ, the market has been down as much as 22% just a couple weeks ago on the S&P 500. So we'll stay consistent here because that's the chart we're looking at. So 22%. Now, I didn't average these out, but if I fly through them again one more time, 13 of these down 21.5, 28, 22.2, 36, 48.2, 27.1, 33.5, 47, 57.8, 33, and again, right now, so far, the worst it's got has been about 22%. Are we closer? The question is, are we closer to the end of this bear market, or are we closer to the beginning of it? And again, the answer to that question requires you to predict the future, which, again, no one can do. So as a result, what we have to do is we have to take probabilities into account. We're 6 to 7 months into this bear market. The average bear market lasts right around, anywhere between, call it 12 to 16 months on average. Does that mean this one has to last another, call it 6 to 12 months? No, it doesn't. But we have to look at the market in a way that's, how are things different right now compared to, say, the dot-com bubble, which was a 47% drop, or the mortgage crisis. Do we have a mortgage crisis or anything like that going on here in the U.S.? Not really. We have inflation, but again, as I mentioned in the market outlook update, in the halftime update, I mentioned that inflation is primarily it's man-made. It's a result of the pandemic. It's a supply problem that's causing prices to go up, primarily a supply and demand problem. It's not an inflation problem. In other words, the reason prices are going up is not because the U.S. dollar is falling in value, which is what inflation is, and the U.S. dollar is not falling, and it's not taking more dollars to buy the same stuff. That's inflation. What's happening is the dollar is breaking out to multi-year highs, meaning the dollar is very strong, and we have a supply and demand problem where there's not enough product out there to meet demand, so prices are rising. And for all those reasons, I think that what we'll probably see is we'll start to see inflation soften up here as we move through the year, as we start to see China and other Asian countries get back into production as they move away from a zero COVID policy. But I'm going to shut up because this was not intended to be a market outlook presentation again, and I've gone completely on a rant here. So I guess we're talking about emotions, and I want to end this one piece of information, this one chart, 13 times that the market's gone down, and I want to end that by saying, what are you going to do this time? That's my question to you as the listener, as the watcher, as the investor. What are you going to do? Are you going to let the market scare you out of a sale this time? How many of these opportunities have you been alive for, first of all, when you look back at that chart, going back to 1950? When did you start your career? When did you have money to invest? So I mentioned this 13 times since 1950. How many times were there really while you were in your prime working years or are in your prime working years? So how many of these opportunities were you even able to take advantage of? How many did you miss? When the market drops like this, we're eventually closer to the end of the bear market than we are to the beginning of it. So we have to really try and let our emotions or keep our emotions in control. And some of that has a lot to do with controlling what we watch and what we listen to. I would argue that what you're watching right now, of course, I'm a little biased, right, is good, valuable, unbiased, objective information. If you watch the financial news, on the other hand, or if you have a favorite political channel, political news you like to watch, I would argue that that's extremely biased, opinionated, and it's meant to entertain, which the funny thing about the word entertainment when it comes to those channels is they usually just fire you up and make you angry. They create worry and concern and unsettlement. That's not what you want. So I think that we need to focus on objective information, and we cannot let markets like these scare you out of a sale. We move on here. What if I'm already retired? So you're talking about investing, right? Investing in a market when it's on sale, taking advantage of the sale. But what if I'm already retired and I don't necessarily, my money's already invested and I'm taking income out of my portfolio? What do I do then? Well, here's some tips. First of all, you can hold off on any non-essential expenses until the market recovers. So if you've got a car that works just fine, I wouldn't go rushing out to buy a new car in one of the toughest times or the most inflationary environments. And I even use the word inflation there, by the way. But it's right now is one of the worst times in U.S. history to buy a car, I think. And I think that that's going to soften up as time goes on, as we get more microprocessors, semiconductors. It takes, I've heard the other day, it takes over 300 microchips to create one heated seat in a Ford truck. So if you imagine how much of a supply problem we have, that's just a heated seat, never mind making the car run. So, hold off on things like cars. Another thing you can do is if you're really concerned or anxious, if the news you're watching, which you shouldn't be watching anymore, in my opinion, go outside and read a book, do something fun, ignore that crap. It's noise. It's going to be behind you at some point anyway. But if you're really, really anxious, you could find part-time work. We have a client who has been retired for a while and having nothing to do with being short on money. He just decided, you know what, I'm going to get into, see if there's any opportunities for some consulting gigs out there. And now he's working 20, 25 hours a week, making really good money, but he's doing something he loves, working from home, and it's no skin off his back. It's no big deal. He's enjoying himself, and he's making money in the process. But maybe there's some other large changes you can make. Maybe you've been meaning to downsize your house for a long time. Well, what a better time to sell your house. Obviously, you got to buy a house, of course, but what you buy will probably be less expensive than what you're selling if you're downsizing. Something that's always a good exercise is, rather than creating a budget, track your spending for the last 3 to 4 months and see if there's anything you can tighten up. Oftentimes, we don't realize what we're spending because we're going through the process of just swiping that card just mindlessly, and then at the end of the month just paying the bill and then wondering why it is that the bill's so high. So I think it's a good exercise and somewhat eye-opening in some cases to go through all your expenses and just kind of see, hey, what is it that I'm spending my money on? Why Why is it that, I'm feeling maybe like I'm a little bit strapped? Obviously, prices of things have gone up, again, due to supply, but there's also probably some things that we don't necessarily need right now that we could forego and help loosen things up. And then ensure you're in the right kind of strategy when it comes to your retirement portfolio. Make sure you're in the right strategy, whether that's the right allocation, the right type of portfolio management strategy. I'm going to fly through just two that are, well, I'll just call them the main two strategies that are out there. Strategic on the right, and for you listening, I'm just going to talk you through this, but on the right hand, strategic static portfolios, this is what we would consider a traditional buy and hold portfolio, although I don't like to call it that because what we're doing inside of these portfolios is what's called sector rotation, asset class rotation, industry group rotation. That's just a nerdy way of saying instead of investing in all of the teams in college football, we're just going to invest in the playoff teams, and that's it. So we're gonna own the championship team, but we're not trying to invest on the championship team. We're not trying to be that focused. We want to buy the top 4 or 8, call it 10 teams, and we want to be invested in the best teams with the best momentum and the best winning percentage, and so on and so forth. Both tactical and strategic strategies implement asset class and sector rotation or stay invested in the playoff teams. Both of them, when the market's going up, tend to do well because when the market's going up, they're both going to tend to make money. Where they're different is that trend-following strategies have a second filter that even though the asset class and sector rotation or staying invested in the playoff teams keeps our performance good on a relative basis, on an absolute basis, everything could just be going down. So it doesn't matter. You could be beating the market, but the market could be going down and your portfolio could be going down as well. And that's where trend following strategy comes in if you're interested in being even more conservative. Now, sometimes that conservatism can hurt in the long run. And what I mean by that is that when the market goes down really fast and it comes back really fast, you get what's called a whipsaw. And that's where you sell low and you buy high because you have to get back in the market at a higher price. No one knows when those moments are going to come until they're behind us. And there's been a lot of those between 2015, 16, 18, and COVID. But right now, the trend following model portfolios or strategies are doing extremely well because they're very cash heavy, and they've been very cash heavy, and increasingly so pretty much since the beginning of the year. So a trend following strategy is going to be very frustrating during short, quick markets, but it's really strong during long, grinding bear markets like the one that we're living in right now. Strategic models are very frustrating during the long, grinding bear markets because we stay in the market, right? That's what the strategy is designed to do. It's if the market goes down and it comes back really fast, we never got out of the market in this strategy, so we're glad we did stay and stay put. And in hindsight, it looks really good. But again, we don't know what the market's going to do until it's behind us. So earlier when I said that sometimes you're in the wrong strategy or you're in the wrong combination of strategies, what we like to do is we like to take, first of all, get to know our client really well, understand their objectives, look at their financial plan output, and then make a recommendation and say, based on your age, your income, your expenses, your tolerance for risk and volatility, we think you should put X% into the tactical portfolio or tactical strategy, and then X% into strategic. And then from there, we drill down even deeper and say, well, what type of allocation do we want to use? So for instance, we might say, let's put 50% of your money into a moderate growth tactical trend following strategy, and then let's put 50% into a balanced strategic static strategy. And now what we have are two different strategies that work in all market environments regardless of what the market throws at us. If it goes down and up real fast, we've got strategic that stay in the market. We're glad we stayed. If we have a grinding, long, tough bear market like what we're living in right now, we've got tactical helping to hold things up. Because the days of owning bonds in your portfolio and bonds helping you to mitigate risk, those days seem to be over, in case you haven't noticed that the bond market's been down 14% over the last 2 years. U.S. Treasury's down more than 30%. So it's been pretty rough. Now, some things you should not do. First of all, don't make a knee-jerk reaction because your portfolio's down this year and just reallocate your portfolio and invest more heavily in bonds. I just mentioned bonds have been terrible this past couple years to the point where there's almost no bonds you can buy that have good growth outlook right now, at least in the near term. Kind of waiting to see if interest rates peak and start to come back down in the short term so that there's an opportunity to invest in bonds. But if you had to, make a prediction, which if somebody put a gun to my head and said, where are interest rates going to be 10 years from now, I'd say they're probably going to be higher. And if that's the case, then investing in bonds is going to be difficult because bond prices and interest rates are inversely related, which means when interest rates go up, bond values go down in value. So that's the first thing. Don't make a knee-jerk reaction and reallocate your portfolio and just invest more in bonds, thinking they're going to be safe, because this year bonds have done extremely poorly. If that's good grammar, I don't know if it is. My apologies. Second thing, do not assume that reducing your allocation to stocks is going to mitigate losses for two reasons. One, again, I know I keep saying this, we could be closer to the end of this bear market than the beginning, and when the market rebounds, you could struggle to reclaim what you lost if now you're sitting more on the sidelines or invested in other investments that aren't going to come back as fast. Third, do not reallocate your portfolio into target date funds just because it looks simpler or easier. In target date funds, they get discretion of your money and they can invest it in anything they want. And if you look inside target date funds, sometimes the investments being chosen are not the best investments in the world. They can be very low-rated investments, low-rated mutual funds, for instance, that maybe aren't performing as well, that you wouldn't buy off the street if you were given a choice, but because you're giving the target date fund discretion with your money, they're going to put it where they want to put it. So I'd rather you allocate your own portfolio with the help of someone like myself or Kim at our office or another qualified financial professional. And then last, again, I know we keep saying this, but do not let your emotions get the best of you. Be objective as much as you can. Try to eliminate bias as best as you can. When we look back at in history, inflation. Here's a headline from the Daily News, and it says inflation rate jumps to 18%. And then below that, you can see here it says U.S. beats Russia in hockey. So we've seen this before. We've been here before in an inflationary environment. And as Mark Twain once said, history doesn't repeat itself, but it sure does rhyme. So I don't think this is going to be exactly like last time. I think it's probably panning out to be similar in some ways. But at the end of the day, this too shall pass. And to kind of put a cherry on top here, all of these next slides are from the halftime market update that I did last week. So if you want to see more details, go check it out on our YouTube page for Libertas. But in the times in the past when we've had really, really bad first halves of the year, like we did this year, the market has a tendency to rebound. So when you look at year to date through June 16th, in 1932, the market was down almost 37%, but it went up 34.5% through the end of the year. 1940, it was down 20.1% halfway through the year, and it finished the year went up 6%. 1962, it was down 22.1%, and then it went up 13.2% during the second half of the year. And then in 1970, the market was down 17.3% in the first half of the year, and the market went up 21% through the remainder of the year. So just because the market's done terrible for the first half of the year doesn't mean it has to do terrible for the second half. Here's another statistic. This is from my friend Ryan Dietrich over at LPL Financial. He's the head of technical analysis there. When we look at the worst starts going, we'll say down 15% or more at the end of June from 1928 until now, so pretty much since the Great Depression. We've got 5 numbers here, not including 2022, but the year-to-date return for the S&P 500 in 1932 was down 45.5%, and the market went up 56% through the end of the year. 1939, it was down 17.4%, went up 14.7%. Again, 1940, 19.9% drop halfway through the year, and then the market went up 6%. 1962, down 23.5%, and then the market went up 15% from there through the end of the year. And then 1970, the market was down 21%, and it went up 26.5% through the end of the year. And by the way, in none of these situations, I have to pull them up to show you, in none of these situations did they go straight up starting on July 1st. So when I'm showing you these numbers, I'm only showing you to give you perspective, but we want to make sure we have proper perspective here. It's still going to be choppy, I assume, through the end of summer. So it's not going to be, smooth sailing. Sorry about this blurry chart. I think this is from Charlie Bolillo. I can't remember where I found this one, but this is every time since 1946 that there's been a quarterly drop in the S&P 500 of 15% or more. So this is since World War II. Anytime the market's gone down 15% or more, this year the second quarter was down 17.02%. And you can see, if you're watching on YouTube, that all but one quarter was positive. The next half of the year was positive, and every single one of these instances out of, 8 of these in the sample size, all of them were higher a year later, and all but one was higher in double digits. All but two were higher, not only in double digits, but 20% or more higher a year later. So, this is just good, honest, objective, unbiased evidence. You can't, in my opinion, you can't finish looking at numbers like these and then go turn on your favorite political news station and say, yeah, but, and stare at the news. It doesn't work that way. The news is, they're trying to scare you. They want you to keep watching, and they want to hook you, and so you won't go outside, and so you won't spend time with your family, and so that you're one day closer to the end of your life and wasting it caring about whatever the apocalypse du jour happens to be today. But I'll shut up here. So, a couple more things. We're in the weakest spot for the market. Midterm election years are tough. The summer of midterm election years are especially tough, as you can see on the chart here. They tend to be very weak. For those of you listening on YouTube, the average return for the NASDAQ is down 5, S&P 1.5, Dow Jones down 1.2 during midterm election years in the summer. But the sweet spot, in other words, this is Jeff Hirsch, by the way, Stock Traders Almanac. The sweet spot for the market comes in the fourth quarter of the midterm election year, once we know who's going to win Congress. In other words, who's going to win the midterm elections. Once that happens and the uncertainty is gone, the market has a tendency, historically and seasonally speaking, to go up right into the pre-election year, which, by the way, the pre-election year is the best year for the market of the 4-year election cycle. So that's good evidence. And then last but not least here, whenever there is a Democratic president, if the Democrats were to lose Congress, in other words, if they lost the midterm elections and lost Congress, then what we're paired up to see is the best alignment, politically speaking, for the market in terms of performance when you go back in times. From 1949 until last year, so until now, when we have a Democratic president and a Republican Congress, the average rate of return for the market is 16.4%. The only number that's closer, or only split that's closer, we'll say, is a Republican president and a Republican Congress, which is up 13% per year on average. So, with that all being said, I think it's important to understand that the sky is not falling, that this is not the end of the world, that we need to control our emotions because we've been through so much. Anybody who's an investor today has been through so much just in this last few years that I think we can handle this as well. So if you have any questions, if you need any help, if you'd like to set up an introduction call, just a phone call to get to know each other, I can actually ask you some questions, get to know you, understand your situation better confidentially. Geez, I can't speak anymore. Confidentially, of course. I'd be happy to have a phone call. And if you'd like a second opinion on your retirement plan, financial plan, and investment portfolio, we would love to oblige. But I think we're going to go ahead and end the show today. So that's it for today's show. Feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, remember that you never, ever have to be a client to ask a question. If you'd like to set up an introduction call, like I mentioned earlier, just head over to our website. You can schedule something in our calendar, or you can email us directly. But as I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on both iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get not only these updates, but also our other screencasts, videos, and articles that we send out directly emailed to your inbox. Feel free to follow us on Facebook at facebook.com/libertaswealth. I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.